I want to get to the end of the show. So let's go to the next article. Ready? Go.
Yes.
Next article, guys. Next article here is from Housingwire. Powell's remarks shoot mortgage rates higher. Okay, so last week, Jerome Powell and the Fed reduced their overnight interest rate by 0.25%, which mostly everyone was kind of expecting. Remember, a couple weeks ago, we were talking about whether the Fed does or doesn't do this. It'll both tell us something. If they flinch and they pause, that tells us something.
Yeah.
And if they don't flinch and they kind of put their heels in the ground and go, no one's going to tell us what to do, we're going to reduce rates, well, it tells us something, too, about their attitude or maybe what the data's telling them.
Yeah.
So, right away, mortgage rates skyrocketed. Womp, womp. That was
it was
real
I
bad.
mean, the 10-year took a huge hit on that.
Yeah.
And just so we all know, the Fed doesn't reduce the mortgage rates. It has some type of impact, but remember, the Fed reducing the rates is only impacting like credit cards, the way the banks borrow money from the federal government. What would be another one? Car loans would be another one. But it doesn't have a drastic impact in the actual mortgages. So that's one thing to understand, because I had a lot of clients, hey, they reduced the Fed. And that day, luckily I had a client, I text them how many basis points it dropped. And I think at the midday, I was like at 41% drop. That's almost 50, a half a percent higher for that rate you were able to get in the morning.
So I'm going to use an analogy that you don't know I'm going to use. I'm going to put a picture on the screen right now on the show, and this is Memo and I at our family Christmas party in a shared sweater, a Siamese sweater. This is what mortgage rates and the Fed is like.
Yeah.
They are not actually connected like Siamese twins, meaning you go where I go, but they are close enough that if you're kind of in that same container, that sweater, if I'm going left and he's trying to go right, there's going to be a struggle, and it's kind of better off we go together. And mortgage rates and the 10-year yield are pretty much like that.
Exactly.
So there you go. And thanks for sharing the sweater with me so we could take some pictures with family. That was pretty fun. No, I don't think anyone was expecting that. So go ahead.
So also the down, it says right here, the actual down was also overturned by 1,000 points that day.
Oh,
so
the Dow took a nosedive, bro.
You know? And, you know, before it used to be the reverse, right? If interest rates went higher, the stock market did much better. But nowadays it's like, it's hard to even understand that.
Nothing correlates.
Stuff that used to correlate doesn't seem like it's correlating, or it has a brand new correlation. You're like, wait a minute, how come that's the way it is now?
Yeah.
And this has been talked about in other conversations I kind of follow in economic space and monetary space. Is like, well, okay, the markets are all going up. Also, gold is going up. Bitcoin is going up. Like, is everything a safe haven now? Real estate prices are going up. It's like, okay, is everything a safe haven? I don't argue that they are, but they're kind of all acting like they are. If stocks are all going up and Bitcoin and you have gold going up and you have housing and real estate, it's like something is going to have to be the stabilizer there. It can't be all those things.
You know, and here it goes again. It's all the influence that a person may have, right? Like Jerome Powell is the most influential man in the world. You know, that guy just
Dos Equis guy?
Seems, besides him, he's the most interesting man.
Oh, that's
This guy's the most influential, right? Very different, two different people. But no, we're good. We get it. But yeah, if that guy just seems nervous of anything, the market reacts to that, which is crazy. And it specifies right here, you know, Powell didn't seem very confident while answering some questions about inflation and the labor market. You know, as soon as he just kind of hesitates with something, the market already can predict what's going to happen, so they adjust immediately.
You know what's so interesting about that is they go in there with their prepared notes, and they go in there with their, if I get asked this question, I'm going to answer this way. But it's like, you know what that can't change? Your body language.
Exactly.
You have to, like, act a certain way to cover up your natural body language when you're addressing some of these questions people had about, especially about inflation and the labor market. And these things are housing and mortgage related because they impact those things directly.
Yeah.
These are not indirect forces. When you're talking about affordability, people that can or cannot get qualified for a mortgage, inflation hurts people. Their jobs can help them, and if they're qualifying, and if you don't have a job, guess what?
Yeah.
You ain't qualifying.
You ain't qualifying.
So
you ain't getting it.
These are kind of inextricably linked to the housing market, and if you show that you're uncertain and you're kind of unsure and you can't cover that up enough, then people are going to see you flinch, and then now all of a sudden the markets have this reaction.
And although here's the, number 2, it says the Fed raises its inflation forecast to 2.5 PCE for 2025. 2 years ago, achieving this would have seemed like a miracle. right? Because their whole goal's always been, I want to get it to 2%.
Yep.
Now it's like, it seems like, okay, we're getting comfortable with this.
Yeah.
Even though it seemed like a miracle, I still see that when I go to the store, when the consumer goes to the store, we're still paying the same price, if not higher, than when we started, when inflation was, you know, that 4 or 5%. So I don't get it. Is that the new norm? Is that what we're talking about the previous time, that the new norm with rates, is that going to be our new norm?
I love your preparation, because literally on that same point, I wrote the following. After it ran red hot for back-to-back years, never making a retreat. This is the issue. So you can say, hey, we're going to get to 2%, we're going to get to 2.5%. But the years it was like at 9%, it never retreated.
Yeah.
So if, again, I'm going to correlate this to weight. Since it's Christmas Day, I might be eating a lot right now as you're watching this. So if I'm 200 pounds when I start the month, and then I go up to 209, and then I go to 211, and then 212, I'm still gaining in total weight, even though it's slowed in the rate of the gain. This is exactly what this is.
Yeah.
So them saying, oh, we're going to go back to 2.5%, that's fine. When it was at 9%, we didn't go negative to retreat at all. We went to 9%, stayed there, and now we're like, oh, we're going to go 2.5%, and we're 2.5% more, and we're still going to be facing an uphill battle.
Yeah,
is my bottom line gripe.
Yeah,
I guess I should be more merry. It's Merry Christmas, guys.
Well, you know, I know, but it's because it's hard, right? We used to have the dollar menu at McDonald's.
Oh, here we go. All right,
yeah, here
the dollar menu at McDonald's.
It's coming.
All
back
right, and then the torta is going to come up next.
Yeah. And here it is, right? The torta, everything else. But we don't see that anymore. And now even McDonald's, we saw an article where McDonald's or fast food is considered a luxury now.
I know. So isn't that crazy?
I want to bring that because this correlates with all of that we're seeing there. If our inflation has miraculously gone down all the way to 2.5%, well, why is everything still so expensive? Yeah. Why are we considering that, you know, going out to a fast food is considered luxury? How is that? I thought going to Ruth Chris was luxury, right?
What is that now?
This is all because of rate of acceleration, not direction of acceleration, or deceleration. So anytime there's a plus in front of that sign, or in this case, it just says 2.5. There's no plus sign. That also means there's no negative. So if there's a vacancy, then it's a plus. And if it's negative, then we'll actually be in a deflationary situation where I started at 200 and went to 209. Maybe I retreated back to 204. Then I'm losing weight in this example.
Well, we haven't. We've just been slightly growing.
This is a direct correlation to the same thing we talk about when it comes to house prices.
Yeah.
You know, we talk, in some areas of the country, homes went up 20%, 30% in those specific territories. And then they never went back down. They just kept going, but at a slower rate. Yeah. And this is more of the same.
Yeah.
So the Fed has an uphill climb to, in my opinion. I think they have headwinds coming into 2025. The wind is definitely not at their back. I think they're going to be fighting the data.
Yeah.
And I'm going to say one of the most disappointing and I say discouraging things, and this isn't to be dour, but I think the idea that the amount of pressure on the labor market still has not been enough means that they have to leave enough runway for there to be more pain in the labor market to achieve the outcome they want.
Something they kept bringing up, the labor market has not fully broken.
Yeah, it's not completely
it's very
broken.
strategic. Like when they say broken, not slow. Now they're saying broken. Before it was slow. Slow. And
remember they say softening of the labor market?
And I pay attention to the words that they use because now they're blatantly being open about what's actually what they're actually looking to happen. Before it was kind of like I said, little by little conditioning you. And now it's like, no, we need it to break.
Yeah.
Yeah, if I was like wrenching down on your neck and like a chokehold, like, I'm just trying to soften your neck up. And then you're like, you just come out right before Christmas. You're like, now we haven't broken it yet. Wait, what just changed? You were just trying to massage my neck real tight there. Now you're trying to break it? Okay, Fed, we get it.
Yeah. I mean, on the positive side, this is good news for people that are buying. You know, it usually should bring like scare tactic, right?
Yeah.
But this is the time that you're going to have less competition.
You're so right.
You know?
The how sucks, but it is true.
So it's there. Now it's the time, you know? So I know even though it sounds like doom and gloom with all these things that are happening, it's like now is the time.
This is the
time.
Don't
follow the herd.
This is the time for people who, and we said this last week.
Yeah.
If you're looking to buy a house in 2025, like in the spring or summer, you start now.
Yeah.
So yes, I have to talk. look, I had to bring it up to say like the whole labor thing because it's still going to potentially happen.
Yeah.
But for those of you who are homeowners and you have your job right now and you're like, hey, I need to get out of some financial distress, use the home to your advantage. Yeah. We're going to be coming to a point here where we're talking about home equity. That's what I'm talking about.
Yep.
So call these guys and talk about a HELOC, talk about a cash out, talk about changing your rate or whatever you got to do to cure your financial situation. Yep.